Let's start on that inflation point. What's your read on if inflation expectations can continue to go down, or if that reverses if gasoline prices start to rise again?
So consumers are, of course, going to be very aware of gas prices, but they are responding to the prices of everything that they purchase. We've seen inflation expectations 1 year ahead decline quite a bit, not just this month, but over the last couple of months. Just 2 months ago, it was 4.9%. Now it's 4%. Consumers are expecting the slowdown in inflation to continue over the next year.
The sentiment numbers are amazing, Joanne. The current conditions number has gone from 59.4 to 68.6. That feels like a very big jump. Am I reading that right?
It is a big jump, and it's happening for two primary reasons. One, as we mentioned before, the slowdown in inflation has really helped consumers' pocketbook. The other thing is that buying conditions for durables have gone up quite a bit, and that's because consumers are perceiving that supply chain issues have really eased up or have disappeared for durables. So both of those things are propping up current conditions.
What about the labor market? I mean, how is that helping or supporting that current sentiment?
So labor markets kind of has two pieces to it. So first of all, consumers, their assessment of their personal finances are also being buoyed by expectations of strong incomes in the year ahead. We're seeing a median increase of about 2.6%. That's higher than we've seen recently. And so consumers expect their incomes to be strong, and that will support their consumption going forward. That being said, they are expecting labor markets to weaken in the year ahead. The largest proportion of consumers expecting unemployment to increase than we've seen in recent months. And so they are expecting that to weaken.
Nevertheless, if I look at these data, I'm assuming that consumers feeling fairly good about the world right now. I hear what you're saying. There are caveats. How should the Fed be reading this data, do you think, Joanne?
I think the Fed should look at this data and feel like their fight against inflation has worked to some extent to control short-run inflation expectations. But what we know is that the Fed cares much more about long-run inflation expectations, and that's at 3.0%. It's been bouncing around between 2.9 and 3.1 for 17 of the last 18 months. So in spite of this recent reduction in inflation, it hasn't really moved the needle all that much on long-run inflation expectations. But those weren't really all that much higher than pre-pandemic inflation expectations to begin with.
So, Joanne, what is going to move the needle on that longer-term inflation expectations? What's going to get that down more substantially?
I think it has to be a really sustained reduction in inflation. So, Guy, you were saying before, consumers seem to be very hopeful. The thing is that they're very hopeful relative to where they were 6 months ago when we saw the all-time low back in June. So overall, consumer sentiment remains fairly low from a historical perspective, just less low than it was before. And I do think consumers are still waiting to see sustained improvements and kind of uncertainty over global factors like China and the war in Ukraine to not worsen in the year ahead.